Okay, and we're live. And g'day, it's Scotty from Xenium.Live. And this is a special USA edition. So it is 10 a.m. Tuesday in Australia, where it's already tomorrow, and 5 p.m. Pacific time in the US. And today I'm honoured to talk to Ellis Hammond. How you doing, Ellis?
Hey, so am I in the future right now? Like, is that that's a good question.
Mate, it's a very weird situation. All you need to know is that even though we're down under, we're ahead of you guys. That's all we need to talk about.
That's right. So that's good to hear, man. Well, I'm really pumped to be here, and this should be a lot of fun both for the Australians, the Aussies, and for the American folks here on the West Coast. So looking forward to it.
All right, well, that's good. Well, look, I don't want to get in trouble in calling you guys anything now. So, Aussies often call Americans Yanks, but is that offensive to you guys? I don't want to be offensive.
So I'm a good Southern boy, man. So we refer to all the Northerners as Yankees. So yeah, I would be offended by that for sure. That might cause some scuffle between me and
So, what can us Aussies call the greater population of Americans as we're Aussies and you're what should we call you?
Yeah, that's and gosh, I Yanks is the first time I've never actually knew that. That's slang to me. We have so much slang for one another. To classify as an entire population would be hard to do. I don't know if I can quite give you one. So Americans is the best.
All right. Well, over the course of these shows, we'll get a name there, and I'll be able to tell everyone we've secured a name. So look, mate, I wanted to talk to you. We connected on LinkedIn quite a while ago, and I want to talk to you about your journey and your history, because you went from essentially pastoring to property, and I want to know what made you make the change, and how it came about, because I know that in one period of time you had like 2 units, which we'd call in Australia, we call a duplex. So 2 units, and then within a period of 9 months, you've jumped to being involved in a 144 unit deal. So, mate, give us a bit of your background. We're all interested to know.
Yeah, it's been a wild ride, man. It's been a lot of fun. And, I actually started my career as a college pastor and Christian missionary out here in San Diego, California. I'm on the East Coast, and I moved to San Diego to with a team of folks to kind of begin to build Christian faith-based campuses all across San Diego. And that was, man, what I was passionate about doing, is helping young guys like myself and just begin to ask the bigger questions about life and begin to find something I really like, college. And had an incredible time doing that, man. But it was probably 5 years in, where I just began to. I've always been an entrepreneur. I've always loved things. I think, one of the reasons why I went into the mission field was just I love building things. I love being a part of something bigger than myself. And we just began to kind of, as a missionary, we were raising every dollar we needed to support our ministry. And so, I got to a point where, as our ministry was growing, I saw the needs of our ministry growing, that I just began to wish that I wish I knew how to go and create capital on our own. Like, I wish I knew of an investment vehicle that could go and create a predictable income stream that could support the things that my wife and I were passionate about, if that was our ministry or if that were things that we'd be doing in the future. But Scott, I didn't know. Like, I don't know what happens over in Australia, but no one really talks or teaches you how to actually build wealth in the United States. You go to
good point.
22 years of schooling, and no one actually teaches you, besides of go get what they teach you is to go get a job and to work 9 to 5 and then put money away in the stock market. Well, I watched my dad do that, until he was 55 and passed away. And I can tell you this, man, up until the day that he died, his number one worry in life was money. And, and I just never, that really stayed with me. So to answer your question, real estate began to make a lot of sense, because it was something that I could predict, right? It's a revenue stream that I could essentially count on, because I could, bank on the tenants paying me rent every month. And so for a simple guy like me at that time, man, with not a ton of financial education, real estate made the most sense. And it was something that I could begin to map out and see ways that we could really begin to build wealth in.
Okay, that's really good. That's really good. So how did you go from 2 units to to 144? I mean, I know you're involved in 144, but I mean that's a big jump. I mean, I'd say 2 units to 4 or 2 units to 8, but I mean 144. That's 77 times.
Yeah. Well, I'm not sure what was harder, man. I always tell people I think the duplex was harder because one. And honestly, right, like you just don't know what you don't know. And I would say the 144 unit was pretty easy once we were in the world of real estate, because what I learned about the duplex was that I actually don't love all the components of investing in real estate, right? And especially when you're doing small, you're the landlord, you're the property management, you're the landscaper, you're kind of doing all
Yeah.
those things. And I realized,
Yeah.
man, that was not for me. I was still a college pastor when we bought the duplex, so I knew that if we were going to continue to try and scale this, doing this a duplex at a time was not going to work for our schedule. And so I needed something that could allow me to do what I did best, which honestly is create communities, build relationships, and it was raising money. I was already raising money for our nonprofit at the time. And so the way that I did that so quick, 9 months later, is I learned about this thing called syndication, where you could essentially pull together, capital from private investors, and then, essentially you become the management or you become the deal finder, right? And partnering with someone else who had experience. And so him and I put together a GPLP structure. We went and raised money from our private network of investors or supporters at that time, and we put together a deal. And man, it was so much easier than doing the duplex, because all I had to go do was essentially, go show people that we had something of value to offer them, that was an alternative to the stock market. And honestly, I never looked back, man. A new world became open to me, the world of syndication, and honestly, the world of finance and the world of capital, alternative investing. It's really changed my life and my outlook on life, man. I just think I see it as a beautiful vehicle to really help people and people in a much different way. And so I'm all about it. I'm really excited for it.
So I'm intrigued on one of the comments you made there with you're already raising capital for your the charity not for profit or whatever the structure is that you use there, and so you revisited those supporter base that you had, and so was that did you put them into a real estate investment instead of the charity side, so that I guess what I'm saying is, did you pool their funds to do the real estate investment so they got a return on their funds and they could keep building, and then you got a fee for doing it, which was then supporting your work to do in the charity side, rather than just the money going in and disappearing? Was that the concept, or was it something different?
Yeah, I mean, well, it was a separate LLC and entity than the nonprofit, so they weren't
Sure.
necessarily matched in any means. But yeah, I mean, that's the idea, and that was why, I mean, really longer working in the ministry. We are full time. I'm a full time real estate entrepreneur. I like to say, right, our own now. Just because I believe in what we're doing so much that, man, I want to fund the kingdom. I want to fund initiatives. I want to be more on the capital side. But yeah, back then, that was my hope. Like, I wanted to create a revenue stream for myself that was actually outside of having to raise that money. And I was on a mission to figure out how do we create income for ourselves instead of having to always rely on somebody else to provide that. So yeah, I mean, I went to those supporters, and it wasn't many of them. I mean, I didn't, it was my first couple grand that we raised, and just said, hey, like, we actually can provide you a return on this money, right? Where
Yeah.
before it was, I mean, I think there's a return in any type of charity or nonprofit that you give, right? You
Sure.
may not see that return, but a return is surely there in the lives that you impact. But it's also nice to see a monetary return as well. And so that was something a little bit different.
Well, it's interesting because it creates an evergreen return. Like, I mean, essentially, your money goes into a real asset that's then providing a cash return to the capital providers. It's creating a money stream an income stream, I should say, for you, and that can be directed however it needs to be to continue that charitable work. So I think it's a great win-win. I think the concept is very good.
Well,
I think we know, well done.
yeah, and that's why I love syndication. And we have not done this yet, but we run a community for Facebook investors. And I have several guys in our group who actually use a portion of the cash flow, a percentage of that cash flow, and they donate that to a nonprofit. And like that is the entire vision of why we get into this. Like, what if we had a vehicle that every single month could just kick off reliable cash flow to the things that we were passionate about? And I mean, that's why I love this business. That's why I love real estate, because I mean, yeah, we can get wealthy individually, but there's so many. I mean, think about how many people are getting wealthy in this asset class. A stock really only is kind of a two-way thing, right? The company benefits, you benefit. But think about how many parties are being able to benefit, are really sharing in the wealth there. Me as the operator, you as the investor, our nonprofit is getting support, the tenants who would live in this apartment complex and the service that we provide to them, right? I mean, it's just a beautiful, I don't know, I love that word evergreen, and it's evergreen for so many people.
No, that's a good point. Now we've got one of our serial commenters on, Steve Skeen. He's asking what prompted you to think about passive income. So what was the big driving factor there that made you want to get into that side of things?
Yeah, it's a great question. I mean, I think it goes back to it was really reliable income. Again, I was raising money at that point to live on. I mean, we were missionaries, so we were raising our funds. We were fundraisers, and so I wanted another income stream. I wanted something to be able to support us outside of what we were doing, and I think that's true even today as an entrepreneur, as a business owner now. The passive income for me is a predictable, is a reliable income stream that I have outside of my job. Outside of business that I own. That's why most of our investors are actually entrepreneurs and business owners, because I actually don't want people to quit their job, right? Like, I think entrepreneurs are God's gift to society, right? Business owners, I mean, we're designed to work. I just want my network of investors to have the freedom to create even more. I want them to have the freedom to be able to use their time most effectively and not have to worry about money. And so if they have a predictable income stream, a passive income stream that they can rely on outside of their other business, dude, we can create some really incredible things together. So that's why I like passive income. I don't, I mean, again, I'm not, I wouldn't say I'm completely against stocks, but I really like this idea of passive income, just because, I mean, I know if you look at the way most of the billionaires hold their wealth, a lot of it is actually in their business. A lot of people hold wealth in their business. And so I want people to be freed up to really double down, triple down in their business.
Yeah, that's a good point. That's a good point. So touching on the 144 unit complex, I mean, that's what you would define as multifamily. So define multifamily for you guys over there. Is it everything from 2 units to 250 units, or what is it?
Yeah, I would. So, I mean, most people would call multifamily. Well, I guess the same way we call duplex, flex, quadplex, or fourplex, and then outside of that, I think it becomes multifamily. Our typical,
okay.
or our particular investment firm, we're only, we call it mid-size multifamily, which is 750 units. I think large multifamily, probably 200 units.
Right. Okay. So I guess I'm just trying to clarify the picture for some of the Aussies listening, is that they probably don't understand. I mean, we would have apartment complexes which go up, but you have a lot of sprawling complexes which are like villas, I guess we'd have here, that go out.
Mm-hmm.
So your 144 unit complex, was it? It's not apartments. It was sort of more villa style, or how would you describe that?
Yeah, they call it garden style. Is
Right.
kind
Okay.
of they call it here. And yeah, it is kind of one level, and it kind of sprawls out, because we got land. I mean, and that was in a very rural area, so it was very spread out. But still, I mean, and it depends on the city. That's a good question. I mean, that was near Memphis, Tennessee, and kind of a more rural suburban area. So there is definitely a lot of land there, and things were more spread out. I do think there were two levels though to that. So there were kind of top and bottom units, and a lot of the other markets, same way. Tucson, they can be, 2 or 3 levels. But yeah, typically they are kind of spread out. They have a courtyard, or they have kind of like a grassy area in the middle.
Okay.
And typically that would be called a garden style apartment complex.
All right. So you didn't build them; they were already built.
They were already built.
Yep.
We
Okay.
predictable, reliable, and extreme.
Yeah. No. That's so just going in as a purchase. So in rough figures, can you sort of run us through how the figures looked for that deal, just to give everyone a bit of an understanding? The total costs or the yield or whatever.
Yeah, so that deal was a $9.5 million purchase price. We, that was, I'm trying to think what our debt was on that piece of property. We raised just north of $5 million. I believe our debt on that property was right at $3.5 million. Might have been a little bit more than that. I have to go back and look. And when we purchased that property, we purchased that deal at right around a 6.5 cap. And if I'm not mistaken, we returned just shy of 8% on capital invested in year one.
Yep. Okay. Okay. All right. And is that managed? Does that have on-site management, or how does that work the same way there?
Yeah, exactly. So we have a property management company, a third-party property management company on that deal, and so we do, and that was one of our value add, what we call value add, in the sense of, there's kind of two ways to increase the value of a property: you either decrease expenses or you increase income. So our main driver on that property was decrease expenses, and part of that came from just kind of better property management.
Yep. Okay. All right. No, that's good. That gives me good understanding. Okay, so so at 144, I mean, I don't have the figures in front of me, but I mean the average rental, because your rentals are in monthly figures there, aren't they? So it's rent per month. So your 144 units are renting at, what are they renting at, about 1,500 a month or something?
Oh no, not in that complex.
No.
That not in that area. That's more about $900 a month.
900. Okay. 900. Okay.
Most of the
All right.
properties that we look at, that kind of our game plan is around the $700 to probably $1,200 a month max in the markets that we're looking at, and that's mostly we're chasing yield, right? Our investors are looking for yield, and so those markets allow us to be somewhere between 50 and 100K per unit purchase price.
You're right. Okay. No, that's good. And okay. So when I was looking at stuff, well, when we were doing stuff in 2004, we were in upstate New York, and that was the rental figures per month we were looking at then, was about the 650 to 850 a month in duplexes and triplexes. So I can understand that price point. So okay, moving on from that, I've got one question before you do from that. Steve's asking, what is the loan interest rates on your 3.5 to 4 mil loan?
Back then or now?
Either or.
Well, back then we actually we assumed a really great loan on that deal. It was at 3.25% interest rate on that property. And I actually believe we just refinanced that just shy of 4%. So great interest rates on those deals. When you think about 3.25% fixed, or even 3.8, even 4%, for 10, 15 years, I mean, that's a great guard against inflation. Even if, even the property's going to continue to appreciate, but, and we're cash flowing. So, I mean, that's why that deal was so attractive to a lot of our investors. It's, look where we are right now. When you got an interest rate that's fixed for at least a decade or more, that was really attractive. So, and that's non-recourse. I don't know how they do there, but we're able to get non-recourse debt, which
Sure.
just means we're only held liable to essentially the property itself. There's no real personal recourse on those loans.
Yeah. Yeah, no, that's good. Yeah, we don't. There's not too many situations we have that here. My understanding is it's only in our super funds, which you would call, is it 401ks?
Mm-hmm. Mm-hmm.
Yeah. Okay. All right. So, okay. So moving on from that and going into the future and the present of the future, where did you go from there? So you put that deal to bed, and what, you had a big holiday, or you've gone, right, I love this. What am I going to do next?
Yeah, so that was at the end of 2018. Still working for the nonprofit, and that was kind of proved the point for us. And we spent 2019 really getting ready to kind of transition. I knew pretty much then this was the start of something big, and this is what we were going to put together. And so we spent 2019, most of 2019, you might call it a holiday. I would call it getting ready for 2020, just because this is a business. I think that's what most people need to realize. I mean, most people go the duplex, triplex, fourplex route because you can kind of still do that in a side hustle. But man, when you start getting to 100, 150 units, this is no longer a side hustle, right? And you're raising several $1 million. I mean, you need to be responsible for the people you're doing. And I realized that, and I could no longer do this as a side hustle. So we did go after 2 more deals in the Phoenix area in 2019. Both of those deals fell through. They were 45 units a piece, pretty much around 45 units a piece. One of those deals, I just couldn't line up enough capital, still early in kind of my career, and couldn't get the capital in quick enough. Another one of those deals, the seller got cold feet and just kind of backed out.
Mm-hmm.
And so that was in 2019. And so here we are in 2020. We have our own investment firm called Symphony Capital Group out of San Diego. There's 4 of us. So we have 2 full-time underwriters. I do marketing and kind of raise capital, and then an operations guy. And we're in the middle of COVID-19. And honestly, man, we're looking at a couple of deals around February, and then, COVID happens. And you look at multifamily market, the way you value that is based on income. And when you're not really sure what's going to happen to your income, it's really hard to underwrite deals. And it's also really hard to get lending on deals. So most of the debt right now from Fannie and Freddie, which are the big lenders here in the States, you are having to come in with 12 months of reserves. So 12 months taxes, 12 months interest, and 12 months reserve for unit. And so,
Wow.
that's a lot of reserve you need to come up front. And so the way some people are doing that is they may ask the seller to hold an escrow that reserve amount from the purchase price. I've seen some creative deals like that. But the biggest reason I think things are slowed down is that us as buyers aren't really looking to buy purchase 2019 prices, and they're still hoping to get 2019 prices. So there's definitely this kind of, there's this very big slowdown in the deals that we're seeing come to market. Most sellers are just kind of not coming to market with deals. And so we're not seeing nearly as amount of things kind of come up on our radar. So we're developing an off-market strategy to essentially go direct to seller and kind of go that route, and hope that will create some more opportunities for us.
Yeah, okay, that's good. So, I mean, essentially, you're telling us what the market is showing you, which is similar to here in the sense of there's not a lot of hurt in the market just yet. So when sellers come on with prices, they're still fairly strong. But the reality is the team behind you, your capital providers and your team are saying, well, we know the prices should be lower, right? And the sellers aren't willing to drop just yet. So we've got to wait for a time until they are, right?
Right, exactly. I mean, I shouldn't say, if I was owning a property right now, I wouldn't sell it for what I on the other side want to buy for, because I think everybody's in a waiting game. We don't know, Scotty. Like, that's the thing, man. I mean, our government in most states right now are providing funding to people who are unemployed, and in most states, that income actually more than they would make in a W-2 job in that state. So it's better for most to be unemployed at the moment, right, than to be employed. That has some incredible implications. Meaning, how long will that last? What happens when that dries up and we can no longer do that, or the government stops doing that and people aren't working? And right, like the lifeblood of of apartment complex is its tenants. And so, I mean, there's some great long-term fundamentals about multifamily, right? People need a place to live. The demand is surely there. The supply is definitely short, but uh, it's tricky. I mean, how do you predict what's going to happen in the next 12 months? I think that's why people are being cautious. I mean, interesting enough, 6 months ago, most deals, I mean, I would say even the deals we were underwriting, we were projecting 2 to 3% annual rent growth and thought we were being conservative. Now, you would be crazy to do a deal that predicted any type of annual rent growth for the next 18 months. And we're actually predicting negative rent growth for the next 12 months. So, that's the interesting thing about, where we are right now.
So
that's a guess, right? That's a guess because you don't know.
Yeah, that's right. That is right. So, so Steve's elaborating on that question. He's saying, "Are property prices declining significantly?" Well, you're probably not seeing that. We're not seeing that just yet here either, right? Because everyone's holding back.
Yeah, I mean, there's no reason for them to decline at the moment. Rental income has not dropped very much in the U.S., so it's still held pretty strong. I think most people were scared that they weren't going to make rental collections, but that's just not been the case. I think that's for a lot of reasons. I mean, again, the government's providing people money. I mean, they still have that. There's a lot of for that, but I think that if this continues to go longer, this is a more long-term thing. So I do think prices will decrease, but I don't think we'll see that in Q2. I don't think we'll see that in Q3. I think this will be a more trickle-down type effect.
And just on those assets that you're holding, and specifically the multifamily that is purchased on a yield, so you bought it on a 6.5% cap rate. So if across the board the rental income drops, right? Does that mean there's got to be a bank revaluation of that, or at what point is the catalyst for the bank to step in and say, "Oh, well, your rent's dropped now, so at a 6.5% yield, we're only valuing it at the lower amount"? How does that work?
Well, yeah, but I mean, we would never do that. If that, that's the beautiful thing about getting long-term debt on these deals. Now, the reason our strategy right now is to go off market and to target people who do have a balloon payment coming up in the next 6 to 12 months, because they're forced to get that evaluation. Now, to forget who the gentleman was who was asking property prices. Steve. I mean, even if they had to do that right now, I would say they would probably get still a strong valuation because income is held steady, right? And that's why prices are not tanked. But again, some of these folks, I mean, when you bring in 12 months of reserves, some people may not have that. They're not that liquid. And so that's some of the things that we're looking for who might need kind of a bailout, and then we can negotiate on price there because they're looking to get out. It's a tough lending environment. They got a balloon payment coming up. So there's some opportunities there. And then again, I think if COVID continues to ramp up, even still, like we're at, very high unemployment rate, at some point we're going to begin to feel the effects of that. And, there might be some opportunity to negotiate prices then. But, so I do think, like I said, I could see this being more of a trickle down effect than, prices are getting slashed. It's just not the case. And honestly, That's why we love this asset class, because it is doing well in one of the worst, immediate downturns. One of the most crazy. It's still performing strongly. And so I'm glad to see. I don't think we should expect to see just this massive slash in prices. Because it's a strong asset class. We know that, and it's always performed really well during a recession. So I do think there'll be some good prices to negotiate, and we can get down a little bit. But I mean, dude, no one's going to be buying this thing for 50% off. That's just crazy. Like this is,
Yeah.
there's money out there that's going to be in the US.
Yeah, no, that's a good point. Steve's jumped in saying we in Australia experiencing volatile valuations, which is talking about when the banks go in and val, especially in the higher density living areas, Sydney and Melbourne, and that are affected by international migration. So what's happening here is the banks are coming in and they're putting different parameters around some of their requirements on the lending, and they're looking a bit deeper into things, not just, show us your pay slips, but what industry are you in? Because they've got a list of industries that have been affected by COVID and things like that. So that's some pretty some strange stuff going on at this end.
They're actually looking at you're talking about the rental itself and seeing what industry the majority or the tenants are in and evaluating it that way.
More from our side as purchasers, because we're not really talking about, we're talking about more individual purchases than, say, 144 lot purchases. So just in terms of what the banks are doing here. But I wouldn't put it past our banks to look at the tenant makeup when they look at an asset selection here. We've got PJ jumping in, saying unemployment benefits last 26 weeks. Set your clocks for October 2020. All right. Well, that's true. We're watching that date here too, because there's a whole bunch of things that are going on at this end, which is similar but different to what you guys are having there with unemployment. We've not just got unemployment. We've got what they call the job keeper, which is essentially a payment for you to keep staff on and pay them wages and things like that. And they all end around that October time. Mate, moving on to your future.
Q3, Q4 is definitely going to be an interesting time. It's what we're preparing a lot of officers for, and it's a waiting game. But I mean, that's also what we're building. I do think, especially we're a younger firm. We really can't rely on our broker network. We're just not strong. If I'm a broker, my mindset is go with the old dogs, go with the guy, go with what's been working, because I need to make some money coming out of this thing real quick. And we're not in that pool. So it'll be a fun 6 months for sure.
And just, you said before we move on, I want to talk about your mastermind community before we switch off for the day. But just before we do that, you talked about you've got a couple of guys that are underwriting. Just explain to us Aussies who probably don't. We would associate underwriting to insurance firms. Underwriting in terms of your firm, what does that mean?
Yeah, I mean, that's why I have two guys doing it, because I really have no idea, to be honest. What I mean by underwriting is we have a couple different phases the way that we work. So we have property that comes in, so we'll see a deal come across our desk. And initially our phase one is we look at it, is it in an area right? Does it fit our criteria in the sense of is it in a good area? Is it around, we want job diversity? I mean, we've already defined our market, so let's skip that. We've already hit our markets because we have certain criteria in our markets. So we find a property come across our desk in our market. Our underwriters or our guys that do this time, they're doing phase one real quick, 5 or 10 minutes. Typically it's purchase price, compared to, or unit price compared to rental income per unit. And that can get us pretty close if we know we're going to be in a ballpark, asking price range. From there, we look, we might go a little bit deeper and just look at the actual neighborhood that it's in. And then from there into phase two, get a little bit deeper. And so that's when we'll actually look at, the rent roll, the expense report, and just see kind of where they are. And if there's some room there for us to be able to grow our income or decrease our expenses, if this looks like an opportunity that we might want to proceed. And once we put
they're the ones heavy on the background info. So the underwriters are the guys doing the due diligence and the background info on the deal. Does that be a fair comment?
Underwriting, they're doing the dirty work, the numbers. This is the spreadsheet, kind of looking at analyzing it exactly.
Okay, cool. Thanks for that. All right, so you got to tell us about your mastermind community. What are you doing now? And then I'll let you go and have dinner.
You guys have is that a term you use there?
Oh, look, it is. We would know what it means, but we have seen it used. Be think tank, whatever you want to call it.
And
It's just a group of
yeah,
like-minded people, I guess.
I would say this, like, the thing that's helped me advance in any area of my life, especially, in my early career, has just been the connections that I've made along the way. And so the power of a mind is in the connection. It's, we've known this from forever. You hear this all the time. It's not what you know, it's who you know. And
Yeah.
I just think that's so true, especially in our world of commercial real estate. So we have a mastermind. Kind of the two themes that really tie us together are our faith in Christ. And so this is a community for faith-driven investors, and it's for those who are building a business around commercial real estate. And
Right.
so, we just we're in an industry that it really helps to be connected and be able to share resources and even capital or deal, because there are skills that we're looking at that we get that aren't really, that might be a good fit for somebody else, or vice versa.
Mm.
And so we have a mastermind community called Kingdom Capitalist. And yeah, we're a community for those who are really building a business in the real estate world, but also are looking, I guess the reason what we say is we worship through our work. And so we want to be more about this. We've used a couple words like passive income or financial freedom. No, we want to be about God's kingdom and really building that here on earth, and really using our business for something much bigger. And that our mastermind community really holds each other to that standard. And so it's been a lot of fun, man. It's something that we started, and it really allows us to do this together. And so yeah, kingdomcapitalist.co is that website. And we have a
All right.
podcast show as well.
Well, that's good. Well, look, now's your time. Tell everyone how to follow you, connect with you, whatever. Give us some websites and some podcast names, and of course, this is recorded so they can go back and
Well,
listen.
yeah, if you enjoyed this and you are faith is something that's kind of part of your framework, Kingdom Capitalist podcast show is a great way to hear from other faith-driven entrepreneurs. The best way to chat with me is on LinkedIn. Doing on LinkedIn, that's how we met.
Yep.
And then probably the two places to go learn about us, ellishammond.com is where I send most folks who are looking to get or invest in U.S. real estate. And so if that's you and you're looking to become a passive investor in some projects, or heck, you're just, you're looking to even partner on some deals, ellishammond.com, or email me at invest@ellishammond.com. And yeah, that would be a great thing. Kingdomcapitalists.co is our mastermind community. Would love to chat with people there as well.
All right. Well, Ellis, thank you very much for coming on today. It's been it's our first US-based show, and we're calling it Merican Mondays because it's Monday your time. But as I said before, we're in Australia. We're way ahead of you guys. It's already almost lunchtime Tuesday. So come on.
Yeah.
So mate, thank you again. And look, for everyone who's listening to this on the Real Property, Real Wealth podcast. You can connect with us at www.xenium.property. So that's Xenium.property. And if you want to join and keep updated with everything that we do, it's xenium.property/join. And you can email us at hello@xenium.property. All right, so that's all we got time for today. Thank you again, Ellis. I appreciate it. And I reserve the right to talk to you again soon.
Enjoyed it. Thank you for having me.
All right, have a good evening.